This is the sentence that ended one of Europe's most celebrated technology companies. Wirecard said there was a prevailing likelihood that trustee 1.9 billion euros in bank trust account balances did not exist. Not stolen from an account. Not transferred to a secret wallet. The company was warning that the asset itself might never have been there. And Germany's federal police say the confirmations used to prove those trustee accounts were fake or inauthentic. That distinction, missing money versus non-existent money, is the key to the whole case. Because a missing balance creates a search. A balance that never existed creates a much more dangerous question. How did a number this large survive audits, lenders, regulators, and years of public warnings long enough to support a DAX-listed company? Start with scale. In its audited 2018 figures, Wirecard reported just over 2 billion euros in revenue, 347 million in net profit, and 1.923 billion in equity. Now put the disputed cash beside those numbers. 1.9 billion euros was almost an entire year of reported revenue. It was nearly equal to all shareholder equity. It was more than 5 times the year's reported profit. The European Parliament's briefing did not call that a rounding error. It said the amount was unquestionably material. The same report shows total 2018 assets of about 5.86 billion. Against that earlier balance sheet, 1.9 billion is roughly one-third of everything the company said it owned. This was not one suspicious transaction hiding inside a giant bank. It was a load-bearing asset. Wirecard processed electronic payments. In Europe, its bank could act as an acquirer, the institution connecting merchants to the card networks and moving funds through the system. But outside Europe, Wirecard said it relied on third-party acquiring partners. Those partners served merchants. Wirecard recognized the transaction fees as its own revenue, and money held back as security could be placed into escrow accounts managed by trustees. That creates a chain. Merchant activity creates fees. Partners report the activity. Wirecard records revenue. Trustees report cash. Banks supposedly confirm the trustee balances. Every arrow looks ordinary by itself. Together, they create distance between the company reporting the profit and the bank supposedly holding the cash. Distance is not proof of fraud, but it increases the number of places where an auditor must obtain independent evidence instead of accepting a document passed back through the same chain. SMA's review records a revealing detail from the later KPMG investigation. KPMG could verify that 2 third-party acquirers made a total of 85 million euros in payments into accounts at Wirecard Bank. But for a separate final trustee balance of 1 billion euros, Wirecard was unable to show KPMG the underlying trustee bank statements. That difference matters. 85 million had a trace KPMG could verify. The much larger trustee balance depended on evidence that did not arrive in a form the special review could validate. Then, on June 18, 2020, the ordinary audit failed to produce the answer Wirecard needed. ESMA says the auditor informed BaFin about falsified balance confirmations concerning 1.9 billion euros in trust account funds. 4 days later came Wirecard's statement. The balances probably did not exist. 3 days after that, the company applied for insolvency. The supposed cash trail led to the Philippines. But the Philippine Central Bank governor said the 1.9 billion euros did not enter the country's financial system. The 2 banks publicly connected to the story said Wirecard was not their client and had no business relationship with them. That gives us the contradiction in its cleanest form. On one side, documents presented as proof of enormous bank balances. On the other, the institutions at the end of the chain saying the relationship was not real. When independent confirmation finally replaced documents moving through the company's own reporting chain, 1.9 billion became zero. Wirecard's collapse was sudden. The warnings were not. The European Parliament briefing traces public reporting about accounting inconsistencies back to 2015. In early 2019, whistleblower allegations and reporting questioned the scale and reality of parts of the Asian partner business. Wirecard rejected the accusations. Meanwhile, it had entered Germany's DAX 30 index in September 2018, replacing Commerzbank. The market had elevated a fintech story over a traditional bank, while the accounting questions were becoming more specific. The response from the supervisory system is where the story becomes bigger than one company. ESMA later identified deficiencies, inefficiencies, and legal or procedural obstacles in Germany's financial reporting supervision. Its review said the scope of the examination should have expanded into the third-party acquiring business earlier than October 2019, after serious public allegations about the existence and volume of that revenue. It also found that examination procedures were not always sufficient or timely, including in seeking contact with relevant outside parties. And during part of the controversy, German authorities investigated market manipulation and restricted short selling in Wirecard shares. That does not mean every critic was correct. It means the system spent scarce attention on people betting against Wirecard, while the load-bearing cash proof still had not been independently resolved. Here is why non-existent cash can cause damage larger than the missing number. A reported asset does more than sit on a balance sheet. It makes the company look solvent. Solvency supports credit. Credit funds operations and expansion. And continued access to funding makes reported growth look sustainable. Germany's BKA says investigators suspect false financial statements helped induce German and Japanese banks and other investors to supply roughly 3.2 billion euros, money the BKA says was likely largely lost after the insolvency. The allegation is not that 1.9 billion was simply swapped for 3.2 billion. The mechanism is leverage. False confidence in the balance sheet can unlock more real money than the false asset itself. That is the multiplier. Claimed cash, 1.9 billion. Outside funding identified by investigators, roughly 3.2 billion. The second number is about 68% larger than the first. The Wirecard story can look impossibly complex because it crosses payment networks, subsidiaries, partner merchants, trustees, banks, auditors, and regulators. But the central belief was simple. If the revenue was real, the cash should eventually appear somewhere independent of Wirecard. The company could explain why customers were distant. It could explain why partners processed transactions. It could explain why trustees held collateral. But every layer of explanation made direct bank verification more important, not less. The case did not collapse because someone finally understood every payment in Asia. It collapsed because the proof at the end of the chain failed. The collapse happened in June 2020. The legal story is still active. The Munich court continues the criminal proceeding against former chief executive Markus Braun and others on suspicion of organized commercial fraud. The court has listed hearing dates through December 23, 2026, and explicitly warns that those dates do not tell us when the trial will end. Braun is not described here as convicted. Former executive Jan Marsalek remains listed on the BKA's wanted page. We do not speculate about where he is. Those open proceedings are a reminder that an accounting collapse can become publicly obvious in days and still take years to adjudicate person by person. There is also a measurable institutional consequence. In its 2024 follow-up, ESMA said Germany had substantially revised and strengthened its financial reporting supervisory system. The old two-tier model was discontinued. Supervision was placed with BaFin. Investigative powers, cooperation, and information exchange were expanded. ESMA also reported better independence rules and improved examination procedures. Those reforms do not retroactively recover the money, but they identify what the system concluded had to change: fragmented responsibility, weak information flow, and processes that were too slow for the evidence in front of them. Wirecard's 1.9 billion euros is often called missing cash. That phrase is almost too gentle. Missing cash suggests money left a real account. The official record describes something more corrosive: trust account balances that the company itself said probably did not exist, supported by confirmations authorities described as false. The number was close to a year of revenue, close to all company equity. It helped support a balance sheet that investigators say attracted even more real funding. And it survived until direct verification reached the banks at the end of the chain. That is the Wirecard lesson worth remembering. Complexity can explain where cash moves. It can never substitute for proof that the cash exists. If you want financial crime stories built from the records instead of the mythology, subscribe to the Con Ledger. The next case file starts with the document everyone else treated as boring, and the number it could not explain.